Welcome to today's Retirees with Wayne Maslyk, Certified Financial Planner, a program designed to educate you on family-focused retirement and tax planning. Today's Retirees is brought to you by Great Lakes Benefits and Wealth Management and Allen Thorley Deloitte Insurance.
And welcome to this edition of today's Retirees with Certified Financial Planner Wayne Maslyk, Great Lakes Benefits and Wealth Management. You know, Wayne, last time we talked about life insurance and estate planning and tax planning for, well, use the term wealthier.
Wealthier folks, people that have managed to put a nice nest egg away, $500,000, $1 million estate, and they wanted to make sure that they passed their estate in a tax beneficial way to their loved ones. Yeah.
Those folks that actually started retirement saving when they started
working. When they should have, right.
Not when they said, oh, retirement's right around the corner, what do I do now?
Right, yeah.
But today we're going to talk a little bit about continuing that theme, life insurance. Talking a little bit about, you know, the guy that, you know, maybe working stiff, if I can use that word, and he didn't maybe plan so well. You know, he did things a little bit backwards than what we've talked about over the last several months. You know, life insurance for the average guy. I mean, there's so many different kinds.
Yeah, a lot of people go into retirement and they have policies that they've carried over the years. Either policies to cover their mortgage or their college funding for their kids if something were to happen to them, or maybe even policies that, you know, their parents got them, whatever. But they hold on to some of these, you know, our old policies. And a big question when we go through planning is, hey, Wayne, should I keep this? Should I keep paying this premium? Or should, you know, this is a paid up policy and, you know, the death benefit's $50,000, but the cash value's $30,000. So the true insurance amount is only the difference, right? The $20,000 difference in that example. So that's a big question. Do we keep this insurance? Do we cash it in? Do we get new stuff? So that's kind of what I'd like to cover today.
Right. Now, when we're looking at that, I mean, you know, I can see, you know, I mean, just, you know, use people that I know, and, you know, people that, you know, 50 years old, is that a different mindset than if you're 40 or 60?
No, again, each family has their different situation. You know, if a family still has debt, you know, they owe on their house or whatever else, you know, you should have insurance there to cover that. Most folks that have a mortgage or a large debt load, you know, buy term insurance to cover that. So if they, you know, if they do happen to pass away, the main breadwinner, before that debt is paid, the surviving spouse or the other heirs don't have to pay it. You know, it's paid, the insurance covers the bill. But we don't just look at debt, we look at final expense. You know, we have you know, funeral and burial costs that need paid. Some people like to have policies that pay for that.
Okay.
You know, you have to be careful with those. A lot of people will prepay for their funerals. You know, but you know, funeral homes go out of business. Right. And then now that's gone. So be careful with that. I like to have cash set aside or earmarked or life policy that, hey, this is our final expense. When we pass away, you know, those bills will be paid by this. Then you can pick and choose the funeral home or you know, whatever that you want, not the one you prepaid and you hope they're still in business, you know, down the road.
20 years from now.
Or longer.
Or your circumstances have changed. You're not in the same community or even the same state.
Sure, absolutely.
I don't know. I've never looked at those. Do those transfer to?
No, a lot of them don't, no.
Okay.
Yeah, no, it's with the home that, you know, hey, I want to be buried, or, you know, the service at this local place, and you know, you're taking a chance that they're going to still be around.
Wow, I wasn't aware of that.
Yeah.
Now, if let's say that you know, Jim Bob has a policy that he bought you know, X number of years ago, and he's been paying on it, and it's becoming due. Maybe it's a 20-year policy, and he's been paying on it since he was 30 years old. Started having children and things, and he wanted to protect that. He's 50 now, and he's got, you know, 2 or 3 years left on that. Is that something he should look at right now to extend, or, you know, I mean, there's all of those variables are there.
Yeah, most any type of a term policy, that's a policy that doesn't build cash value, is going to have an ending date. And in order to re-up that at a favorable underwriting class, you have to be able to re-qualify for it.
Sure.
If you cannot re-qualify, you have to pay the guaranteed rates in that plan, which are generally ridiculous. So if you think you're still going to need coverage, and you're approaching the end of that term coverage, you should start seeing if you qualify for another plan.
Okay.
You don't want to wait till that end date and then hope you can.
Right.
And then if you can't, you have to start making plans. Some of those term policies, the companies allow you to convert to permanent policies without any additional underwriting. So if you have a 20-year term and it's 15 years in, some companies will let you turn that term into a whole life or universal life, some type of a permanent product.
Okay.
So you can continue it on past the original term time.
Okay. We're going to take a break here in a minute or so, but when we come back, I'd like to, if you don't mind, I'd like to talk about those three terms that you just used. Term, whole life, actually there's four terms: term, whole life, universal life, and permanent. I mean, you use those, now you use those a little bit interchangeably,
Yep.
and I think I know what you're talking about, but I'm just wondering
We'll
if
specify. Yeah, absolutely.
if our audience understands those four terms.
Yep.
So that we don't get caught in some, because I'm sure that insurance agents use those terms a lot when they're sitting down at the table
And
with
they
us.
assume the folks know what they mean.
Right.
But yeah, there are major differences between those. And yeah, we'll touch on that when we get back.
Okay. Well, we're going to take a little break right here. Folks, you stay right there. This is Today's Retirees with Certified Financial Planner Wayne Maslyk of Great Lakes Benefits and Wealth Management.
Schedule your appointment with Wayne today by calling 866-626-3990 or visit todaysretirees.com.
Wayne Maslyk is a certified financial planner, which is the standard that all other financial advisors are measured. What this means to you is simply this: credibility. As a certified financial planner, Wayne assists you in family, estate, and tax planning from an independent perspective, not from a sales perspective. Wayne does not work for an investment or insurance company, but gives advice based on your family's unique needs, not the sales goals of an insurance or investment firm. Call for a free consultation with Wayne to see how to reduce your existing or estate taxes, better use the retirement funds you have, or plan for the retirement that is fast approaching. Call toll-free 866-626-3990.
Allen Thorley Deloitte Insurance has been locally owned and represented for over 100 years. That means if catastrophe happens, we've probably seen it, and we'll walk you through the process of making everything right again. Representing some of the finest insurance companies in the industry, Allen Thorley Deloitte shops for you, giving you the personalized service, advice, and coverage you deserve. Yes, it's really that simple. Let us customize a plan for your personal or business insurance needs at 800-628-1057 or visit atdinsurance.com.
Find out why Wayne Maslyk Certified Financial Planner is the right choice for you.
Many do-it-yourselfers read and watch financial shows, but when you look at the actual rate of return that they've earned on their investments, or when you look at the state of their estate plan, are the documents updated? Is everything in line? A lot of times it's not. So those folks, if they're not doing a great job themselves, they need to come in and see me. Call the office, talk to my staff.
Now back to Today's Retirees with Certified Financial Planner Wayne Maslyk.
And welcome back to Today's Retirees with Certified Financial Planner Wayne Maslyk. Today we're talking about life insurance. When we left for our break, Wayne, we told them we were going to talk about those four terms. You used the term a minute ago, a permanent. You used universal life, you used whole life, and you used term. Now, some of our folks are saying, well, duh, I mean, those were no-brainers, but some of us aren't that bright, and we need definitions.
Sure. Well, first of all, there's two main types of life insurance. You have term insurance and permanent insurance.
Okay.
Term insurance is designed to provide coverage for a specific period of time. It's temporary.
Okay.
The term means you're going to be covered for 5 years, 10 years, 15, 20 years, whatever. Okay. Some of the term policies even go 30 years now.
I see.
So a 40-year-old can get 30 years worth of coverage, takes him or her to age 70, and then it goes away.
Okay.
Permanent insurance is designed to go and last well into the future and be in force when you die. Whether it's in a year or 40 years, it's designed to be permanently there.
So it never goes away?
Well,
as long as you pay the premiums.
There's that's a maybe, because you know, things change with these plans. I'll give you an example. Generally, a whole life policy, as long as you pay your premiums, yes, it will be in place.
Okay.
A lot of folks got into trouble with the universal life policy. I'll try and explain a quick difference without putting folks to sleep. A universal life policy is flexible. You can pay in X amount of dollars or more or less, as long as there's a cash value in there. The plans are extremely flexible. Okay? But a lot of the projections that were made when folks took these things out were based on certain assumptions, certain mortality costs,
okay.
and mainly certain interest rates. Now we know interest rates are real low now.
Right.
So a lot of these plans were based on an 8% or 6 or 10% interest rate. So if you paid X amount into this every year or every month at 8%, well, you're going to be fine. But now, you know, if it's 2%, or if you're in one that's tied to the markets and you're losing money like we did in the 2000s, early 2000s, and in 08, the policies end up going, they blow themselves up, because all of a sudden the person gets a notice, hey, you need to put $2,000 into this now every year, otherwise it's going to go away, and the people don't have the money.
Ah, right.
So that's the problem with universal life. There's a lot of variables, but the good part is it's flexible. If you have some extra money, you can put it in. If you're tight one year, you can not put it in.
Okay.
The whole life, you kind of pay the same premium every month, every year. There's no variables. You have to pay that premium.
Okay.
And it's generally more expensive, but the whole life most likely will be there down the road.
Okay. Now I've talked to folks who down the road, you know, they just stopped paying on one of these policies because the policy said, if you stop paying at X number of ages, then they start taking money from what you've already paid in. I don't understand what that is.
Yeah, I'm not sure what that is either. Some of these plans, if you keep paying, they'll keep growing. There's dividends in some of the whole lives that pay out. They keep growing.
I see.
So, you know, without knowing the specifics, it's hard to, on this show, to get into the specifics on how each policy works. But you have to work with somebody that runs the different scenarios for you. Worst case scenario, how long will this plan stay in place? If you want it to go into the future. A lot of people just cash them in. You know, once you have a plan that's old, the cash value in there generally is big enough to where it's almost approaching the death benefit. So if that spread, if that difference isn't that great, some people just take it in and go invest their money in a mutual fund or whatever with it.
Sure.
Others hold on to them and they say, hey, this is for my burial. We're going to keep this and keep it in force, make sure it doesn't lapse. So you have to manage those. You don't just set them aside and forget about them. And that's unfortunately what a lot of people do.
Right.
You have to look at that statement every year. You have to look at the assumptions on the statement. You have to go over it with your advisor, your financial advisor, and you have to make sure it's doing what it's supposed to do.
Right.
And you have to look, does it make sense to keep it?
And what you just said is what we've been talking about on this show for a year, is getting good advice from good people so that you can plan for your estate.
And stay on top of it.
Right.
You just don't do it once
Yeah.
and then forget about it. In all phases, your investments, your insurances, your tax planning, you know, all that, the legal planning has to be maintained on a regular basis. Maybe not every year, but you know, at least every couple years you have to stay on top of it. It's not a do once and forget about it, because things change. The economy changes, the markets change, your life changes. So, yeah. And again, that's what I help folks do.
Right, and that's folks, you know, let me just encourage you to go to the website, todaysretirees.com. or email Wayne at todaysretirees.com
or call, yeah.
Or call the 800 number, 866-626-3990. Some folks there will help them. You can set up an appointment. The first appointment consultation is free. You'll take them through and look at some of the things and talk to them.
Yeah, most folks that work with me, the meetings are no charge to them. But at the first meeting, we do make sure that it makes sense to have future meetings.
Right.
Sometimes it doesn't. Sometimes I can't help the folks. Sometimes they don't want help. Sometimes they're doing just fine, and I tell them, hey, you're doing just fine. Keep doing what you're doing.
Right.
That's a rarity, by the way, but it does happen.
Right. All right, we are going to take a short break. This is Today's Retirees, Certified Financial Planner, Wayne Maslyk.
Schedule your appointment with Wayne today by calling 866-626-3990 or visit todaysretirees.com.
Wayne Maslyk is a certified financial planner, which is the standard that all other financial advisors are measured. What this means to you is simply this: credibility. As a certified financial planner, Wayne assists you in family, estate, and tax planning from an independent perspective, not from a sales perspective. Wayne does not work for an investment or insurance company, but gives advice based on your family's unique needs, not the sales goals of an insurance or investment firm. Call for a free consultation with Wayne to see how to reduce your existing or estate taxes, better use the retirement funds you have, or plan for the retirement that is fast approaching. Call toll-free 866-626-3990.
Allen Thorley Deloitte Insurance has been locally owned and represented for over 100 years. That means if catastrophe happens, we've probably seen it, and we'll walk you through the process of making everything right again. Representing some of the finest insurance companies in the industry, Allen Thorley Deloitte shops for you, giving you the personalized service, advice, and coverage you deserve. Yes, it's really that simple. Let us customize a plan for your personal or business insurance needs at 800-628-1057 or visit atdinsurance.com.
Find out why Wayne Maslyk, Certified Financial Planner, is the right choice for you.
Then there's folks that need to come see me that maybe are a recent widow or widower and just need some help getting their financial house in order. Or there's folks working with current financial advisors or brokers, and maybe the brokers are taking too much of their money at risk, losing it to the stock market. So come see me, folks. Call the office and set a time that's comfortable and convenient for you. And
now back to Today's Retirees with Certified Financial Planner Wayne Maslyk.
Welcome back to Today's Retirees with Certified Financial Planner Wayne Maslyk. And today, Wayne, we're talking about life insurance. And as we left, you were talking about some of the cash built, what was the term you used, where it builds cash in the...
Well, some folks that have had policies for a while, they have a nice cash value accumulated. Cash value? Yeah, that's the cash in the plan. And the more cash value you have, the more beneficial the plan can be for you. A lot of folks use their life insurance plan as their own banking vehicle. Okay? Instead of going and paying a car dealer interest, or if you need a new roof for your home or whatever, you borrow money tax-free from your own life insurance at a very favorable interest rate. Ooh. The loan comes out, goes to you. The whole value, the original value though, is still earning the interest. Whatever type of plan you're in, you're still earning interest, or even in the markets in some cases. Okay. And you just pay yourself back, just like you would a car loan or a bank or finance company. And it just makes you more independent. So let me make sure I'm understanding what you're saying. So I've paid into my whole life policy. Is that what this is? It could be a whole life or universal life. Okay. We like, the whole life tends to work the best. The dividend paying whole life. If folks have those, they know what I'm talking about. But some people have, $30, $40, $50, $100,000 of cash value in this that is there for them to utilize. Okay. And as long as they're disciplined, they loan from it and they pay themselves back. Okay. Then you're paying your own self the interest back. As opposed to a finance company or bank or. So if I use a number, we've got $50,000 of cash value in there, and I need a roof on my house, and that's going to cost $6,000. Yeah. I go and borrow the $6,000 from my own policy. Correct. And then I pay my own policy back some number a month. Yeah. $200 or $500, some number. Yeah.
to pay that back until that is made, the loan is made.
Well, you can pay it back monthly, you can pay it back annually. If there's dividends being paid in the policy, sometimes the dividends will pay your own loan back for you. Again, it's another strategy that folks can use. When we do this show, I'm not making specific recommendations at any of these shows. I just want people to know what's out there. You're not going to know about all these strategies unless you sit with somebody like myself and we talk about your situation, see what you have, see what the future, how you'd like your future to be, your goals and objectives. And then, I share different potential strategies that may make sense for people. Now, people that have policies can use them this way. Folks that have extra money that are looking to do something other than stick it in the stock market or stick it in a 1% CD, these are, again, great tools to even start. You don't have to have it. You could start accumulating money in these types of plans, and then, again, down the road, you'll be your own bank. And you hear the commercials, we talked about it off the air, be your own bank, bank on yourself. This is what they do. Dividend paying whole life, overfunding them, putting plenty of money in, and then using them for your benefit down the road instead of paying some other finance company interest rates or credit card company. Now
I can see one of our viewers, and I don't know who this is, I'm just, but they're going to run out tomorrow and they're going to want to buy this policy.
Yeah, well,
I mean,
you got to be careful.
You have to have a strategy.
Well, it has to make sense with the rest of the things you're doing. Everything needs to mesh together. You just don't go do one thing. We talked last week about using life insurance as an estate planning tool for the people that have sizable estates. This week we're talking about life insurance, more for the average person, and ways life insurance could benefit them. Now, again, it may not be appropriate for them. Maybe a different strategy is. This is just another strategy that's available.
Sure. And what happens to that policy if I get lazy or something happens in my financial life where I lose a job or whatever, and I can't make that loan back? Well, what happens then?
It's a great question. A lot of these policies have a benefit that you could sign up for. It's called a waiver of premium benefit.
Okay.
You have to get it when you take out the plan, and it's just that. If you get disabled, the premium's waived. The company pays your premium for you.
I see.
And you can still use the plan with loans or whatever else, but you don't have to worry about paying the bill as long as you're disabled. If you're permanently disabled, the plan's permanently paid.
Wow.
Yeah. So all those bases are covered.
Right.
But again, you're not going to know about them unless you work with somebody like myself.
And that's the key. I think, all these strategies, folks, and we're out of time, but call Wayne, 866-626-3990. These strategies are available if it makes sense for you, that he can help you out. We'll be back right after this.
Schedule your appointment with Wayne today by calling 866-626-3990 or visit todaysretirees.com.
Wayne Maslyk is a certified financial planner, which is the standard that all other financial advisors are measured. What this means to you is simply this: credibility. As a certified financial planner, Wayne assists you in family, estate, and tax planning from an independent perspective, not from a sales perspective. Wayne does not work for an investment or insurance company, but gives advice based on your family's unique needs, not the sales goals of an insurance or investment firm. Call for a free consultation with Wayne to see how to reduce your existing or estate taxes, better use the retirement funds you have, or plan for the retirement that is fast approaching. Call toll-free 866-626-3990.
If you would like Wayne to answer your question on the air, send your message to Wayne at todaysretirees.com or call 866-626-3990. Here's today's question.
And welcome back to Today's Retirees with Wayne Maslyk. Wayne, our question today is the stock market. We hear a lot, up, down, the crash of 08. Where do we stand today?
Well, believe it or not, and it may not seem like it, but as of the end of April, the stock market has been up for 8 consecutive months.
Oh, really?
8 months in a row, the market climbed.
Okay.
Now, if you've been in the market, you know we've had a great run since March of '09. I mean, since March of '09, the market's up about 100%. I'm just rounding numbers here.
Okay.
100% total. We had a great run in '09. We had a great run in 2010. Market's doing okay now. So, don't be afraid of the market. We've been talking, safe life insurance and safe investing in that. But we also talk a lot about the market on this show. And since we had the question, I just think it'd be good, to just, hey, the market's okay. You got to approach it reasonably and responsibly and sensibly. But don't be afraid of it. Don't be afraid of the market as long as you don't have too much of your money in the market. But it's up. It's up this year. It's been up the last couple years, and as of the end of April 2011, it's up 8 consecutive months in a row.
So your prognosticator cap, if you put that on, should I stay there? Should I stay steady? Should I, where if it's been up all these months, is it due for one of those dives?
Well, it's going to have a dive at some point. But again, it's not to answer your question. It's not that simple. It depends on what you're doing now. Do you have enough safe money versus risk money? Are you using the rule of 100? Do you have a diversified portfolio? Or have you been sitting on the sidelines? See, if you've been sitting on the sidelines, no, you just don't take your cash and go in the market now.
Okay.
That's not what you do.
Right.
But just the market should be part of your overall financial plan as long as you do it the right way.
Right. This, what it tells me over and over and over again as we've done this multiple programs is consistency of the investor, whether it's, planning, but also the right person giving advice.
Yeah, you have to have a coach. You have to have a financial coach, an independent certified financial planner. That's what I am. People that are within the listening and viewing area, I'm here for them. I have 2 locations, one in Sandusky, one in the Elyria area. They should utilize our services.
Absolutely. Well, friends, take the time and give Wayne a call at 866-626-3990 and tell him that you want to meet with him, and he'll do that. We're out of time. We'll see you next time.
Thank you for being a part of today's Retirees. We trust the information discussed on today's Retirees has been a benefit to you. To schedule a no-cost or obligation appointment with Wayne, please call our office at 866-626-3990. A free newsletter is available by calling our office or visiting our website, todaysretirees.com. That's todaysretirees.com. Today's Retirees is a service of Great Lakes Benefits and Wealth Management, Wayne Maslyk Certified Financial Planner, and is sponsored by Great Lakes Benefits and Wealth Management and Allen Thorley Deloitte Insurance. The information on today's Retirees and information on our internet website should not be construed in any manner whatsoever as the receipt of or substitute for personalized individual advice from Wayne Maslyk or Great Lakes Benefits and Wealth Management.